Hello, and welcome to Finance World, where we tell you what's happening right now. Warren Buffett now has a combined wealth of over $81 billion at the age of 90. However, a significant chunk of it was amassed after he turned 50, and $70 billion arrived after he turned 60 and became eligible for Social Security payments. He's been a fantastic investor for 3/4 of a century, and that's the actual secret to his prosperity. The Investing Council of Warren Buffett never dates. I've lost count of the bad investments I've made along the way, but virtually all of them fit into one of the 10 categories of Warren Buffett's financial advice listed below. By taking Buffett's investing advice to heart, investors may avoid some of the usual pitfalls that harm returns and affect financial objectives. 1. Invest only in the things you're familiar with. Getting entangled in overly complicated investments is one of the simplest ways to make a mistake that might have been avoided. Most of us have worked in a small number of sectors throughout our entire lives. We presumably have a good understanding of how these specific marketplaces operate and who the top firms are in the industry. The large percentile of publicly listed firms, however, operate in sectors with which we have next to no expertise. This does not exclude us from making financial investments in these market segments, but we should proceed cautiously. Many corporations run operations that are too complex for us to grasp easily. I'll be the first to admit that I can't anticipate the success of a biotechnology company's medication pipeline, the next key adolescent fashion fad, or the upcoming scientific discovery that will spur semiconductor chip demand. There are enough fish in the water to not waste time researching a business or sector that is difficult to comprehend. Warren Buffett has generally shied away from investing in the technology industry. 2. Never go back on the quality of your work. It's quite simple to say no to complex companies and sectors, but finding high-quality firms is much harder. Throughout the last 50 years, Warren Buffett's investing strategy has changed, concentrating almost entirely on purchasing high-quality businesses with excellent long-term development prospects. Berkshire Hathaway's name is derived from one of Buffett's poorest bets, which may shock certain investors. Buffett was persuaded to purchase Berkshire because it seemed to be a good deal, since the company produced textiles. He thought that even if a company's long-term performance remained dismal, if you acquired the stock at a sufficiently low price, there would typically be some unexpected positive news that would allow you to sell the position for a respectable profit. Warren Buffett's opinion on cigar butt investment has altered as he has gained more expertise. He said that using such a strategy to purchase firms is unwise unless you are a liquidator. Likely, the initial cheap pricing was not such a deal. In a challenging industry, whenever one issue is resolved, another one always arises. These businesses often have modest returns, thus depreciating the value of the original investment. Businesses with higher returns on invested capital can compound profits more quickly than those with lower yields. As a consequence, these businesses' inherent worth increases with time. 3. Make a long-term investment strategy when purchasing stocks. How long should a high-caliber firm be retained after being bought at a fair price? Warren Buffett firmly believes in the buy and hold philosophy. He's been in several of his roles for many years. Why? Buffett maintains a focused portfolio because, among other things, it's difficult to uncover exceptional companies with a continued, brilliant, great future. High-quality firms also earn high profits, and their value grows exponentially. Time is a fantastic business ally, as Warren Buffett once stated. Only patient investors are compensated when fundamentals eventually affect a stock's price, which might take several years. The last factor that undermines investment returns is trading activity. Taxes and trading fees are two ways that frequent stock trading reduces profits. We would be better off purchasing properly and waiting tight instead. 4. Diversification may pose risks. When individual investors purchase between 20 and 60 equities across several sectors, they will reap the majority of the rewards of diversification. However, a portfolio of several mutual funds includes hundreds of stocks. The exact reverse is true with Warren Buffett. Buffett's highest investment was 35% of his total portfolio. Warren Buffett understands that the market seldom presents outstanding firms at affordable prices and invests with confidence in his finest ideas. A portfolio with excessive diversity is also more likely to be involved in several subpar companies, which will lessen the effect of its high-quality assets. 5. Much news is noise, not news. Every day, a ton of financial news arrives in people's mailboxes. Even though they usually read the headlines, they practically ignore all the information given to them. According to the 80-20 rule, about 20% of an event's causes account for 80% of its consequences. Most TV news headlines and discussions are intended to create buzz and stir our emotions so that we will do anything. As investors, we must determine if a news story affects the long-term profitability potential of our firm. If the response is no, we should likely do the absolute reverse of what the market is doing. For example, if Coke's stock drops by 4% due to poor results because of transient reasons, think about purchasing the stock. The stock market is a dynamic and uncertain force. We should be very picky about the news we read, far less engaged. In essence, this is among the most crucial pieces of investing advice. Please like and share this video if you've been enjoying it so far. Also, kindly hit the bell symbol on our channel and subscribe to receive fast notifications whenever we upload new videos. Let's return to the video now. 6. There is no easy button. Yet, investing is hardly rocket science. One of the biggest misunderstandings about investing is that only experienced stock pickers can make profitable decisions. Raw intelligence, on the other hand, is perhaps one of the least reliable indicators of the high rate of return. It doesn't take a genius to emulate Warren Buffett's financial approach, yet beating the market and avoiding behavioral blunders regularly is extremely challenging for everyone. Investors must also remember that no secret method, rulebook, or easy button can provide outcomes that outperform the market. It doesn't, and it will never happen. 7. Understand the distinction between cost and value. We always have stock prices thrown at us. Investors often get fixated on ticker quotations shown on screens for whatever reason, but generally, stock prices are more erratic than the foundational company basics. In other words, there may be times when stock prices have little relationship to a company's longer-term prospects. While stock prices fluctuate in response to investor sentiment, this does not impact how much cash a firm will generate in the future. While there will still be some dispute on a company's potential profit stream, it's often far less than the stock price fluctuation. Investors must distinguish between price and value, focusing their attention on high-quality firms currently selling at the most competitive prices. 8. Typically, the finest movements are monotonous. Stock market investing is not a fast way to get wealthy. If anything, the stock market is particularly fit for gradually increasing our current capital over an extended period. 9. The goal of investing is not to have fun, and dividend growth investing is a cautious approach. Investing in businesses that have previously shown their value is often preferable rather than trying to identify the next big winner in a developing market. After all, the objective is to identify high-caliber companies whose value will increase over a long period. The return on our portfolio will keep hold of itself if we do this correctly. Many businesses offer snacks, drinks, toothpaste, medication, convenience shops, and other essential goods and services that can claim lengthy and prosperous company histories. Many investors would be wise to choose inexpensive index funds. Did you know that most investors fall short of the market by a large margin? We undermine our efficiency in various ways, such as attempting to time the market, taking unwarranted risks, trading emotionally, straying outside of our areas of expertise, and so on. And to make matters worse, many actively managed investment funds tack on many fees, which reduces returns and dividend income. Many investors should consider using low-cost, passive indexing, particularly if they're not worried about producing consistent dividend income. ETF dividends often fall lumpy and experience cuts during bear markets. Most stock pickers fall short of producing results that justify their increased cost. 10. Pay attention only to those you trust completely. In all of his shareholder letters and sporadic interviews, Warren Buffett stresses the need for only funding management teams who are dependable and capable. Warren Buffett chooses his company partners and management with great care. For several years to come, their decisions might drastically affect an investment. And with these 10 tips fresh in mind, you are now hopefully more capable of investing in the stock market. However, bear in mind, there is always risk involved and no one can predict how the future will look. Thanks for watching, and I hope you've enjoyed it.